Hello and welcome to de-dollarisation investment. This analysis is for gold as of 1st of August 2026 with a spot price of $4,080 an ounce. The full report is on de-dollarisation.ca, a long-term buy on the record central bank bid, but rich here with real yields at a cycle high 2.41% and the price below every major moving average. Hold it and accumulate on weakness rather than chase it. The demand side is the long-term case, and it is strong. Central banks bought a record 288.9 tons in the second quarter, up 62% on the year, and they bought into the price drop, which is the tell of a buyer that runs on reserve policy, not price. Poland and China led. The soft spot is Western investors. Exchange-traded funds shed about 76 tons over the month as a hawkish Fed bit, and the half-year pace, 345 tons, was the weakest since 2022. So the structural bid is real, but it is not a stampede. Gold is not cheap, and that is what caps the short term. Real 10-year yields sit at 2.41%, up from 2.31%, and are still rising. The single tightest inverse driver of the price, because a rising real yield raises the opportunity cost of holding a metal that pays nothing. Even after a correction of about 27%, gold is near its record highs in real terms, roughly 2.3 times its cash cost floor. The rate model says expensive. The central bank floor says supported. Both are true, which is why the honest call is hold, not buy. You wait for a better entry. Right now, the tape is against gold. The price is below its 20, 50 and 200-day averages. Momentum is weak with the relative strength index in the mid-40s and the MACD only just trying to base, and it sits about 27% below January's peak. We can't read the futures positioning cleanly this run. The commitments data wasn't retrievable, so that gauge is low confidence rather than a signal either way. The long-term trend is still up, just extended. None of this changes the multi-year case. It is why you wait rather than chase. The risks all run through rates and the dollar, and they are live. The Fed held at 3.75% on the 29th of July and signaled patience, and real 10-year yields have climbed to 2.41%. If they push above about 2.7%, that triggers the bear case. A firm broad dollar weighs on the price mechanically and erodes foreign demand. And the near-term swings are the 7th of August jobs print and the 12th of August inflation report. A hot reading keeps the Fed hawkish on hold and the downtrend has further to run. These are exactly why the near-term call is hold, not buy, even as the years-long case stays a buy. Now weigh the risk against the reward. The bull case is roughly 25% above today. The base case, the most likely, about 5%, and the bear case a fall of about 12%. So you are risking about 12 to make 25. So, our call on gold, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by de-dollarisation investment at de-dollarisation.ca. The link to the full report is in the notes below. Have a great day.